Welcome to the deep dive. Today we're tackling something that sounds maybe a little technical, but honestly, it's super important for your finances. Dividends. Yeah, if you own stocks, you probably get them. But the real kicker is understanding how different dividends affect what you actually keep after taxes. So our focus, our deep dive today, getting into the nitty-gritty of ordinary versus qualified dividends. It might seem like jargon, but knowing the difference can seriously impact your investment returns. It's about being savvy, not just owning shares. Okay, but before we really jump in, just a quick heads up. This deep dive draws from material provided by Farhat Lectures. All the content, the examples, everything we're discussing comes from the great accounting resources over at farhatlectures.com. So whether you're studying accounting, prepping for the CPA exam, or already a professional, definitely check out the website for more practice, videos, and support on this stuff. A big thanks to Professor Farhat for this material. All right, let's start right at the beginning. When we say dividend, what are we actually talking about from the company's view? And then what's it mean for you, the person holding the stock?
Right. So basically, a dividend is a distribution of property. Usually it's cash. That's the most common. But it could be other assets too. And this distribution comes from a corporation to its shareholders. Now, from the company side, the key assumption is that it's paid out of its earnings and profit. E&P.
E&P, okay.
Yeah, think of E&P as like the company's accumulated taxable earnings. It's the pot of profits the IRS cares about. The company made money, paid expenses, has profit left over, and decides, okay, let's distribute some.
Gotcha. And for me, the shareholder.
For you, it's your slice of that success, right? A profit from your investment. But here's a crucial difference from something like interest income.
Okay.
Interest kind of accrues day by day.
Yeah.
Dividends don't. A company could be rolling in profits, but unless the board of directors formally declares a dividend, you don't get anything. That declaration is key.
So it's an active decision they have to make.
Exactly. And generally speaking, whoever is legally entitled to get that dividend, the person whose name is on the list at the right time, that's who pays the tax on it.
Okay, that makes sense for dividends coming out of actual profits, the E&P. But you mentioned it gets interesting. Not everything you get from a company you own stock in is necessarily a taxable dividend, is it? What else could it be?
That's right. This is where that E&P rule is absolutely fundamental. A distribution is only taxed as a dividend if it comes out of that E&P pool. If a company makes a distribution, sends out cash, but it doesn't have any E&P or not enough to cover it, the tax treatment changes completely.
Okay, so what happens then?
Well, the first possibility is what's called a return of capital, an ROC. This happens when there's a distribution but no E&P. The IRS looks at this and says, okay, the company isn't giving you profit, it's giving you back part of your original investment.
Yeah.
So because it's your own money coming back, it's non-taxable initially.
Initially. What's the catch?
The catch is that it reduces your basis in the stock. Your basis is basically what you paid for it, your investment cost. So let's say your basis is $100,000. The company distributes $25,000 but has no E&P. That $25,000 is a non-taxable return of capital, and your new basis in the stock drops to $75,000. It's like getting a refund that lowers the cost of what you own.
Okay, that makes sense. Lower basis means potentially more capital gains tax later if I sell, but no tax right now.
Exactly. Now, there's a second scenario that can happen if the ROCs keep coming. Imagine the company still has no E&P and it makes another distribution. But maybe previous ROCs have already reduced your basis all the way down to zero. You've gotten all your original investment back, tax-free.
Right, my basis can't go below zero.
Correct. So any further distributions at that point, when you have zero basis and there's still no E&P, those are treated as capital gains and they're taxed as such in the year you receive them.
Okay, so it flips from tax-free return of capital to taxable capital gain once my basis hits zero.
Precisely. So just to recap the flow, a distribution can be, number one, a taxable dividend if there's E&P. Number two, a non-taxable return of capital if there's no E&P, which reduces your basis. Or number three, taxed as a capital gain if there's no E&P and your basis is already zero. It all hinges on that E&P account.
That's a really helpful framework. And this doesn't just apply to cash, right? Sometimes companies give out more stock instead. How does that work tax-wise? Is it always taxed?
Good question. Yeah. Companies sometimes issue stock dividends just giving you more shares instead of cash.
Right.
It helps them conserve cash, maybe for reinvestment, while still giving shareholders something. It's usually proportional, so if you own 1%, you get 1% of the new shares.
Okay, but is it taxable income when I get those extra shares?
It really boils down to one simple thing. Did you have a choice? An option?
A choice between stock and cash.
Exactly. If the company says, hey, you can take this dividend as $100 cash or R as 5 extra shares, then even if you choose the shares, that stock dividend is taxable.
Why? I didn't get cash.
Because the IRS says you had constructive receipt.
Yeah.
You could have taken the cash. You had access to it, the
Yeah.
ability to choose it. Since you had that access, they tax you as if you took the cash, even if you picked the stock.
Wow. Okay. So the option makes it taxable. What if there's no option?
Now if the company just says, we're issuing a stock dividend, here are your extra shares, and there's no cash alternative offered, then that stock dividend is generally not taxable.
Because I never had access to cash to pay the potential tax?
Pretty much. You didn't have the choice. You didn't constructively receive cash. Now, when it's non-taxable like that, you do have to adjust your basis.
How so?
Your total original investment cost, your total basis stays the same, but now you spread that same cost over more shares, the original ones, plus the new ones. So your cost basis per share goes down.
Okay, so same total investment, just spread thinner across more shares. Got it. This whole dividend thing, it seems like timing is everything. You mentioned needing to be on the list at the right time. If I'm thinking about buying or selling a stock around when a dividend is announced, when do I actually need to own it to get paid? There are specific dates, aren't there?
Oh, absolutely critical. Understanding these 4 dates is key to knowing who gets the dividend and, importantly, who pays the tax. It can trip people up.
Okay, let's walk through them.
First up is the declaration date. Simple enough. That's just the day the company's board says, we've decided to pay a dividend. Let's say November 25th, it's the announcement.
Right, declaration date, check.
Second is the record date. This is the big one for eligibility. It's the cutoff. You have to be officially listed as a shareholder on the company's books on this specific date to get the dividend. Maybe that's December 10th.
Okay, so my name needs to be on the shareholder list by December 10th.
Correct. Third is the payment date. Also pretty straightforward. That's just the day the company actually cuts the checks or makes the electronic deposits to the shareholders who are on record. Let's say December 25th. Happy holidays.
Nice, okay. Declaration, record, payment. What's the fourth?
The fourth is often the trickiest. The ex-dividend date. Now, this date is usually set by the stock exchange, not the company, and it's typically 1 business day before the record date.
1 day before, why?
It's because of how stock trades settle. It usually takes 2 business days for a trade to officially settle, for the ownership to legally transfer and be recorded, T+2 settlement. So the ex-dividend date is set 1 day before the record date to account for this lag. If you buy the stock on the ex-dividend date or any day after it, your trade won't settle in time for you to be the owner of record by the record date.
So if the record date is Friday, December 10th, the ex-dividend date is probably Thursday, December 9th.
Exactly. If you buy the stock on Thursday the 9th, you won't get that upcoming dividend. The person who sold it to you on Thursday still gets it because they were the owner leading up to the X date.
That's crucial. Buy on the X date or later, no dividend for you on this round.
Precisely. It catches a lot of people who try to buy right before the dividend, thinking they'll get it.
Okay, that ex-dividend date is a real gatekeeper. So what happens if shares change hands, like someone sells them or gives them away in that window between the declaration date and the record date? Who pays the tax then?
Yeah, that's another common scenario where the rules matter a lot. When ownership changes after the dividend is declared but before the record date, the tax liability depends on how the shares changed hands. Was it a gift or a sale?
Okay, let's take gifts first.
If stock is gifted during that period declared but before record date, the tax responsibility for that upcoming dividend actually stays with the donor, the person who gave the gift.
Really? Even though they don't own the stock anymore when the dividend is paid?
Yes. The IRS sees it this way. The right to that dividend income was effectively earned or established while the donor still owned the stock after declaration. Gifting it away right before the record date looks like trying to shift income, so they keep the tax liability with the donor to prevent that.
Interesting. Prevents tax avoidance games. What about if the stock is sold in that window?
If it's a genuine sale, an arm's-length transaction, then the situation is usually different. The buyer, the new owner, is typically responsible for the tax on the dividend, assuming they bought it before the ex-dividend date and are therefore the owner of record on the record date.
So the tax follows the economic benefit in a sale.
Generally, yes. Let's use that example from the material. Sarah, Raji, and Maria. So the declaration date is June 15th, record date is June 28th, payment date July 1st. Sarah owns 500 shares. On June 17th, right in that window between declaration and record, she sells 250 shares to Raji and gifts the other 250 to her niece, Maria.
Okay, so who owes tax?
Raji, the buyer, bought before the X date, so he'll be the owner of record for his 250 shares. He pays the tax on the dividend for those shares, But for the 250 shares Sarah gifted to Maria, Sarah, the donor, is still responsible for the tax on that dividend, even though Maria will actually receive the cash.
Wow. Huge difference between selling and gifting in that specific time frame.
It really is. Shows how precise these rules can be.
Okay, this is all great background on the mechanics, but let's get to the big payoff or potential pain point for listeners,
Yeah.
the actual tax hit. We keep hearing ordinary versus qualified dividends. Why does this distinction matter so much on our tax returns?
This is absolutely where it hits your wallet. The type of dividend, ordinary or qualified, dictates the tax rate you pay on it. It can be a really big difference.
How do I even know which kind I have?
Your brokerage firm or bank will tell you. When you get your end-of-year tax forms, usually a Form 1099 DIV, it will break it down. There will be a box for total ordinary dividends and another box, usually box 1B, for the portion of those dividends that are qualified dividends. You report these on your Form 1040.
Okay, so the 1099 DIV sorts it out. Let's start with the less favorable one, ordinary dividends. What are they and why are they ordinary?
Right. Ordinary, or sometimes called unqualified dividends, these are taxed at your regular ordinary income tax rates. That's the same marginal rate that applies to your salary, wages, bank interest, etc. And those rates can go much higher, up to 37% depending on your income.
So potentially a much bigger tax bite. When does a dividend end up being ordinary?
Several situations. Dividends from some foreign corporations might be ordinary, although many can qualify. We'll get to that. Also, dividends paid on employee stock options often fall into this category. And dividends from certain types of U.S. entities that have special tax rules like credit unions, mutual savings banks, and importantly, real estate investment trusts, REITs. REIT dividends are usually ordinary.
REITs too.
Okay, and here's the big one that catches people. Any dividend that fails to meet the holding period requirement is automatically treated as ordinary. Even if it comes from a regular U.S. company like Apple or Microsoft, if you didn't hold the stock long enough, boom, it's ordinary income.
The holding period again. Okay, so that brings us to the good kind. Qualified dividends. What makes them special?
Qualified dividends get preferential treatment. They're taxed at the lower long-term capital gains tax rates. For most people, that's 0%, 15%, or maybe 20%, depending on your overall taxable income and filing status.
0, 15, or 20%. That sounds way better than ordinary rates.
It usually is, significantly better. So what does it take for a dividend to be qualified? Two main hurdles to clear.
Okay, hurdle number one.
The source. The dividend generally has to come from a U.S. corporation, or it can be from a qualified foreign corporation.
Qualified foreign, what makes them qualified?
Two main ways. Either the foreign company stock is readily tradable on an established U.S. stock market, think big international names listed on the NYSE or NASDAQ like Toyota or Shell, or the foreign corporation is eligible under a comprehensive income tax treaty between its home country and the U.S., like, say, a company based in Japan or Germany.
Okay, so U.S. company or a traded treaty eligible foreign company. What's hurdle number two?
Hurdle two is the one you, the investor, control. The holding period. We talked about it before. You absolutely must hold the stock for more than 60 days during a specific 121-day window.
More than 60 days. Remind me about that window again.
Right. That 121-day period starts 60 days before the stock's ex-dividend date and ends 60 days after it. So to put it simply, you need to own the stock for basically 2 months or so. And importantly, your holding period has to straddle that ex-dividend date. You can't just buy it the day before the X date and sell it right after the dividend is paid and expect a lower rate.
So let me make sure I understand this. Same company, same dividend payment. But if I hold the stock for, say, 70 days across the ex-dividend date, my dividend might be qualified and taxed at 15%. But if my friend holds it for only 30 days, their identical dividend is ordinary and taxed at their higher regular income rate.
Exactly right. That's precisely it. Let's use the Jay and Jason example. XYZ Corp pays a $3 per share dividend. Both Jay and Jason own 1,000 shares, so they each get $3,000. Jay held his shares for over 60 days through the ex-dividend date window. His $3,000 dividend is qualified. Depending on his income, he might pay 0%, 15%, or 20% tax on it. Jason, maybe he bought it just before the X date and sold it shortly after. He did not meet the holding period. His $3,000 dividend, same source, same amount, is ordinary. You pays tax at his marginal ordinary income rate, potentially much higher, maybe 24%, 32%, even 37%.
Wow, that holding period makes a huge difference to the actual cash you keep.
It really does. The qualified dividend rules, especially that holding period, are basically Congress trying to encourage longer-term investment rather than rapid trading just to capture dividends. Meet the requirements, you get the tax break.
That really brings it home. It's not just academic. Those details like X dates and holding periods have a real tangible impact on your investment results.
Absolutely. And connecting this to the bigger picture. Understanding these things isn't just, for passing an exam or filling out a tax form correctly, though that's important. It's about being a smarter, more informed investor. It can influence your decisions about when you buy, when you sell, maybe even what you invest in. If you're comparing, say, a REIT to a regular corporation, thinking about the after-tax return, not just the pre-tax dividend, is key.
Right. It adds another layer to your investment strategy.
It really does. Paying attention to these details, doing that critical thinking, can genuinely boost your overall portfolio performance because you're minimizing the tax drag.
Okay, so as we wrap up this deep dive, maybe a final thought for everyone listening. Take a look at your own investments. How do you typically handle stocks? Are you mostly a long-term holder or do you trade more frequently? And think about how understanding these dividend rules, particularly that 60-day holding period for qualified dividends, might maybe shift your approach slightly. Could small adjustments in your buying or selling timing actually lead to keeping more of your money thanks to lower taxes? It's definitely something worth considering in your own financial picture. That's it for this deep dive on ordinary versus qualified dividends. We hope this breakdown helps you feel more confident in navigating this piece of the investment puzzle. Keep digging deeper, keep learning, and we'll catch you on the next deep dive.